Okay, so you're finally making real money in your business. So then why does it feel like you're always broke when tax season comes around? So there's a specific trap that hits six-figure business owners, and that's what we're talking about today. This is when you work harder, you earn more money, but you keep less. There's less and less in your bank account. Your profits show less and less. I have a client. This client was making $120,000 a year. On paper, she was crushing it. She was outgrowing prior year and just doing better and better each and every year. But in the year that she made 120,000, she also owed the IRS $18,000 in surprise taxes. Now, why is this? Well, I say she fell into the trap. And today I'm showing you the three hidden ways that you're losing money to the IRS right now and exactly what to do to stop it. Hello, hello. My name is Chika Obi, and I'm a CPA. And for the last 16 years, I've helped business owners clean up their taxes, avoid costly mistakes, and keep more money. My philosophy and how I show up is pretty simple. Structure plus strategy equals less taxes and more clarity. So today, I'm not telling you about boring spreadsheets. No, no, that's later. That's another day. Not today. Today, I'm shedding light on how to keep more of what you earn. So today, you'll learn how to stop overpaying your taxes. You'll learn about the six-figure business trap of overpaying taxes. All right, so let's get into it. So the first hidden trap is getting locked into a specific structure. Here's the mistake that I see. Business owners, they start their business as a sole proprietorship, or maybe they go ahead and form an LLC. Now, this is beautiful, especially when you're just starting your business. However, when you stick to sole proprietorship, LLC for too long, you outgrow that structure. You think, oh, I started as an LLC, so this is just what it is. However, when you first start, again, that's fine in the beginning. But once you hit the profit number of $50,000 to $80,000, that profit range, what tends to happen at that point is you start overpaying self-employment tax. Now, again, when I talk about profit, we're not talking about revenue. Again, my client, she was making $120,000 in revenue. Your revenue minus your expenses is your profit. So you're looking at the profit number, that bottom number. And if that bottom number is 50K to 80K or higher, then more than likely, if you are still a sole proprietor, if you're still at LLC, you more than likely are overpaying self-employment tax. Self-employment tax is the 15.3% tax of Social Security and Medicare. So imagine that 50K of profit, you're paying 15.3% tax on every single dollar of profit. And that's what happens when you remain a sole proprietor or an LLC. Okay, now back to my client who was making 120,000 in revenue. She was a sole proprietor and her profit number was 80K. And so that 80K profit, she was paying thousands extra in self-employment tax that she didn't have to. Now, you might be wondering, okay, well, what's the solution? What does she have to do? Well, we had to take a look at her structure. We looked at her structure. We saw how the numbers are performing, not just in that year, but the year prior and what her projections were going to be in future years. If she was always going to be growing, at least for the next 3 to 5 years, growth, 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 more profit, which is beautiful, then she was at a point where she outgrew her structure. And so we went ahead and switched her to an S Corp election. So she started being taxed as an S corporation. And it happened at the right time. And starting in year one of being an S corporation, that's when she started to realize 5 figures in tax savings. So it was a huge, huge part of her tax bill was the fact that she was structured as the wrong type of entity. So again, $18,000 in savings for her specifically. Imagine that $18,000 continuing year 2, year 3, year 4, where you're literally overpaying $18,000 each year to the IRS simply because you're locked into the wrong structure. Now, this is something that if you feel like, oh, shoot, Chica, you're talking to me, my profit number is 70K, 100K, and I'm still in LLC, good. It's good that you first recognize it. What I don't want you to do is go ahead and try to form the S corporation on your own. This is where you do need an accountant because there's more to it than just filing a form with the IRS. There's things that needs to be done with your state. There's additional admin that is needed. And beyond that, as a corporation, you are now an employee of your corporation, which means you need to be on salary, right? So it's much, much more involved. However, what's so beautiful about this is that you have graduated. You are at that level where it makes sense to level up and change your structure. Okay. So that's the first leak, getting stuck and locked into a structure that you've outgrown. Now let's talk about the second leak. The second mistake is burying your head, right? Think like these ostriches that just buries their head in the sand, right? They're just too caught up in the sand. And so that's the mistake. The mistake is you're burying your head in the sand and you're waiting until April to think about taxes. But the reality is the US tax system is pay as you go. So if you wait until the end of the year, now you just don't owe the tax. Now you're going to owe penalties, you're going to owe interest. And in the US with the IRS as a business owner, remember, most of our income is not being covered by withholding tax, as it were if you were an employee receiving a W-2. It is up to you to make quarterly estimated taxes each quarter per IRS guidelines. And so if you're not doing that, you're just burying your head, you're just running your business, serving your clients, which is beautiful, but you're not paying quarterly estimated taxes, you're going to have a problem. You're going to see those penalties add up. You're going to see the interest add up. And oftentimes, and this is really sad, when I see the penalty number almost, if not more than the actual tax that you owe, it's mind-boggling how, again, burying your head, those penalty rates, they add up. The IRS does not play. It's like a subscription. Think of Netflix. You can't use Netflix all year and try to pay for it all in December. You have to pay month by month for Netflix. Maybe they do have an annual plan and that's different, right? But for the sake of this example, you have to pay month by month. It's like a subscription, right? Quarterly. You make your income January, February, March, you have to pay that tax April, right? End of the quarter. So the IRS, same thing, they want their cut now. So how to solve this? To solve this, don't guess, don't bury your head. Something so simple that you can do to start is just set aside a percentage every single month of what came in. So let's say every month on average, you make $10,000 in revenue. Just set an arbitrary number. And usually I say between 20% and 30%. So set aside 20% of that up to 30% of that, right? So that's $2,000 to $3,000. So every month you're doing that. And that's something you can actually automate, right? Imagine you have two bank accounts, right? You have your business checking account, and that's where all your invoices, payments that come in, go into that business checking account. And then every month you make an automatic transfer of 20%. So again, if on average it's 10,000 that you make, okay, 20%, 2,000 each month gets transferred into either a second business checking account, or maybe it's your business savings account, right? Just to a different account. So it's out of sight, out of mind. You're not conflicting that with your overall operational income, right? And that's easy. Just set it aside, put it in a separate savings account, don't touch it. And when quarterly estimated tax time comes around, boom, you're figuring out, okay, how much did I actually make? And what are my expenses? Therefore, what is my estimated tax balance? And then based on that number, you go ahead and pay the IRS. And depending on what state you live in, you'll probably also owe the state, right? But that's an easy fix. Stop burying your head because those penalties add up. Now let's get into the third one. The third leak, the third mistake that I see is buying business things with personal credit card, debit card, or forgetting that lifestyle expenses can sometimes be business expenses. So some commonly missed items. One, home office. You work from home and you have a dedicated space in your home specific to business. That's a deduction. Oftentimes I see business owners that are doing amazing. They love what they do. They're working with their clients. They're passionate about their services, but yet they're not taking the home office deduction, even though they exclusively work 100% from home. So this one is a big one. It can lead to $5,000 of additional tax write-offs. Simple. And again, it's one thing to miss out on that in 1 year, but imagine in year 2, year 3, like it adds up. It truly, truly adds up. So that's one that's commonly missed. Software and apps, things like Canva, Zoom, website hosting. And I hate that we do this sometimes, that we think, oh, it's just $9.99 a month, right? I was paying for Uber subscription. And I'm like, why am I paying for this? But I was paying $9.99 a month. $9.99. And it was something that I just forgot about. It was never linked to my business bookkeeping. And one day it hit me. I think I was in an Uber and it hit me like, wait a minute, why am I not tracking this? Right. And maybe one day I was like, oh, it's just $9.99. But think about it. In a year, that's $120. 2 years, things add up. And so no matter how small it is, make sure you're tracking it, especially if it's business use. I live in downtown, so I'm using Uber so much. That's why I pay for that subscription so I can get cheaper rides, right? So it's business related and it definitely adds up. So make sure you're not missing anything, especially because, oh, it's small. Oh, it's not a problem, right? Because things add up. And think about education. That's another one. You pay for courses, you pay for group programs, coaching, Amazon books on Amazon. Again, I understand that sometimes, especially with Amazon, let's be real, there's a personal use and then there's times they're buying books and supplies and things like that. So remember that, okay, Amazon, whenever I'm buying things related to the business, you have your business card on file, you have your personal card on file. So make sure you're using the right card because again, everything adds up and you want to make sure that you are not missing write-offs because at the end of the year, when you're like looking at your numbers, you're looking at that taxable income number and it's like, ooh, it's kind of high. Like, am I missing any expenses? So you want to make sure that you are tracking throughout the year because by the end of the year, you don't remember things. You're trying to just finish up. You're trying to rest. You're trying to travel for the holidays. So just keep that in mind. You do it right the first time. You have your system in place going forward. Boom, it's automatic. Okay. And remember, if you don't track it, you can't deduct it. Every receipt that you lose is like throwing a $20 bill in the trash. And if you picture that, it's like, oh, hell no. Like, Tika, thank you. That's enough. That's all I needed. That image of throwing money in the trash. And yeah, it's something you definitely need to change. And the beautiful thing is that you don't really have to collect receipts and keep all that paper, right? As long as you're using the business credit card or the business debit card, it's being tracked, right? Your bank statements show the expense. And so when it's time to do your bookkeeping, then you can see, okay, what expenses are actual deductions for the business, things that you use in the business, right? So just use the right card and that really solves it. Okay. So to recap, I want you to make sure you check your structure. What's your profit number looking like? If it's 50K or more and you're a sole proprietor, you're an LLC, it might be time to have that conversation with your accountant about potentially changing your structure to an S corporation. And again, there's nuance to it, right? It's not just, oh, I hit 50K, it's time. No, like, is this an anomaly? Are you about to do less next year? Maybe you're shutting down the business to working part-time. And so that maybe that 50K won't be 50K next year. Maybe next year is 30K. So there's things you need to ask, you need to assess, and even working with an accountant, because there's things that you may not know that the accountant can really give you that big picture to make sure that you're not moving so fast when you're not ready. Because as an S Corp, there's more formalities involved. There's more admin expenses involved. Again, now you have to be on payroll. So there's more responsibilities involved. So you want to make sure you're not just ready profit wise, but that you're mentally ready. You got your accountant locked in and you're ready to go and do everything the right way. Okay. So check your structure. You want to pay your quarterly taxes, and at the least, just make sure you're setting aside 20%, 25%, because the worst thing is, let's say you don't even pay quarterly taxes all year long, but then here's tax filing time and now you're paying your taxes, but you don't even have the money in the bank account to pay the tax, to pay anything. So at the least, just set aside 20%, 30%. And maybe you want to start at the higher range, 30%, and then see how things balance out. Again, like just giving yourself that peace of mind. And then lastly, you want to track your expenses, making sure you're using the business card for business expenses and that you're tracking everything. So the truth is, tax code is super complicated on purpose. It's always been that way. And it's so easy to miss things. And so I'm a CPA and I tell you that I miss things for myself as well. And so I hope that this video is really, really helpful, because I don't want you to guess. I don't want you to guess. And I have a free gift for you. I created a free ultimate tax write-off checklist, and it's specific to business owners that are making at least 50K in revenue in their business or more. And this checklist is packed with 7 specific write-offs that most business owners miss. That home office deduction I talked about earlier, it's in there. In this checklist, I talk about the who, what, when, where, why, how for every expense. And on top of that, you get a video about each expense. In that video, I give you an example. I break down all about that specific write-off. Okay. So this is a huge freebie. So you want to click the link in my description to grab it. Perfect time of the year to do so. And listen, if you are that business owner that is making between 50K and 250K a year, and you know that you need more than just a checklist, make sure you're subscribed to my channel, because I've got something really special coming in the next few days, next week or so. And it's going to really help you get smart with your taxes. So if you've been avoiding your taxes, avoiding your numbers, and feeling like, oh my gosh, I feel so alone, this is going to be so perfect for you. So stay tuned. And remember, protect your money, guard your peace. I'll see you in the next video.